Did you know that working while receiving Social Security can sometimes reduce your benefits, but not always the way people think? Many seniors get caught off guard because they don't fully understand how the Social Security earnings test works. In this video, we're going to clear up all the confusion and walk through the exact rules for 2025. We'll cover the first-year retirement rule, annual earnings limits, what happens when you reach your full retirement age, and even what income is counted and what isn't. Welcome to Social Security Post. If you're new here, make sure to hit that like button and subscribe so you never miss an update. And don't forget, if you have any questions about this topic or really anything related to Social Security, drop them in the comments. I read every comment and will personally reply. The entire Social Security earnings system revolves around one key number, your full retirement age, often called FRA. This is the age when you can start collecting your full, unreduced Social Security benefits. But here's where it gets tricky. FRA is not the same for everyone. It depends on the year you were born. For people born between 1943 and 1954, the FRA is 66. If you were born between 1955 and 1959, it increases by a few months each year. And if you were born in 1960 or later, your FRA is 67. That means even a few months difference in your birthday can change how Social Security treats your earnings. For example, someone born in 1957 has an FRA of 66 and 6 months. Knowing this exact date is critical because your benefits and earnings limits all tie back to it. Not all income is treated the same way. Social Security only counts earned income when applying the earnings test. That means wages from a job, net profit from self-employment, commissions, bonuses, and vacation pay. These are the dollars that matter for calculating whether you've gone over the limit. On the other hand, there are many sources of income that do not count. Things like pensions, annuities, investment earnings, capital gains, interest, and veterans' benefits are excluded. This is where a lot of confusion happens. People often panic, thinking that selling some stock or cashing in a retirement plan will reduce their Social Security. It won't. Only earned income, money from work, triggers the earnings test. One of the most common questions is whether the earnings limit applies to household income or just the individual. The answer is simple. The limit applies individually. If you're married, your spouse's income has no effect on your own earnings test. Even if you file a joint tax return, Social Security still looks at each person separately. That means each spouse gets their own limit, their own calculation, and their own potential reduction. This distinction can prevent a lot of unnecessary stress for couples who are both working in retirement. Now let's talk about the special first-year rule, which applies if you retire mid-year before reaching your FRA. Social Security doesn't just throw the annual limit at you right away. Instead, they use a monthly test for the rest of that year. In 2025, the monthly limit is $1,950. Here's how it works. Imagine you retire in October at age 62 after earning $70,000 earlier in the year. Even though you earned way above the annual limit, Social Security looks only at the months after you retire. As long as you make less than $1,950 each month from October through December, you'll receive your full benefit for those months. But here's the catch. If you earn even $1 over, say $1,951, your entire benefit for that month disappears. That's why planning is so critical during your first year of retirement. If you're self-employed, the rules get even more complicated. Social Security doesn't just look at dollars earned, they also look at the hours you work. If you put in more than 45 hours per month in your business, it's considered substantial services, and you won't qualify as retired under their rules. Even 15 to 45 hours per month may count as substantial if the work is in a highly skilled profession, like accounting, law, or medicine. This means you could technically have low income, but still lose benefits if you're working too many hours in your own business. That's why it's important to honestly evaluate your work and, if necessary, consult Social Security before filing. If you go over the monthly or annual earnings limit, Social Security reduces or even withholds your benefit. In the first year, just $1 over the monthly cap wipes out that month's check completely. In later years, the reduction is more formula-based, but the principle is the same. Earn too much, and your benefit goes down. It's also your responsibility to notify Social Security if you expect to exceed the limits. If you don't, you may end up with overpayments that they will later demand back, sometimes with penalties. This can cause unnecessary headaches, so it's better to keep them informed up front. Now here's a piece of encouraging news. Any benefits that are withheld due to the earnings test are not gone forever. Once you reach your full retirement age, Social Security will recalculate your benefit and credit back those lost months. In other words, your future monthly check will be increased to make up for what you missed earlier. It's like the system eventually evens itself out. This means working in early retirement isn't necessarily a permanent penalty. You might lose benefits in the short term, but you gain them back through higher payments later on. Once you're past the first year of retirement, the monthly test disappears and the annual earnings test takes over. In 2025, the annual earnings limit is $23,400. If you're under FRA and earn more than that, Social Security will reduce your benefits by $1 for every $2 you go over. For example, say you earn $38,000. That's $14,600 over the limit. Divide that by 2, and Social Security will withhold $7,300. If your yearly benefit is $12,000, you'll only end up with $4,700 for the year. That's a big reduction, but it's also predictable if you understand the math. Things change again in the year you actually reach your full retirement age. The earnings limit goes way up. In 2025, it's $62,160, and the reduction is smaller, $1 for every $3 over the limit. For example, if you earn $70,000 in the months before your FRA birthday, that's $7,840 over the limit. Social Security will withhold about $2,613 from your benefits. But once your birthday hits, you can earn as much as you want for the rest of the year with no further reductions. This is why many people plan their retirement date carefully to maximize benefits. The best news comes once you fully cross into FRA and beyond. At that point, you can earn as much money as you want, work full-time, start a business, whatever you like, and your Social Security check won't be reduced at all. That's the freedom many retirees look forward to, because it means their benefits are secure no matter their income level. But one more word of caution. Even though the earnings test disappears after FRA, income taxes can still affect your benefits. If your combined income is high enough, up to 85% of your Social Security benefits can be taxable. For individuals, the threshold is $25,000, and for couples, it's $32,000. These numbers haven't been updated in decades, which means more and more retirees get caught paying taxes on their benefits. So while your earnings test goes away, your tax bill might still go up. It's also worth mentioning that the Social Security Administration has special regulations for survivor benefits and for people earning income outside the U.S. The rules can differ significantly in those cases, and the best approach is to speak directly with SSA or a qualified advisor. The main point to remember is that not every situation is covered by the basic earnings test. So let's recap. Before FRA, your benefits can be reduced if you earn above the limit, with special rules in the first year and in the year you reach FRA. Once you pass FRA, you're free to earn as much as you like, though taxes may still apply. And remember, withheld benefits aren't gone. They're added back into your payment calculation later. Thank you for watching Social Security Post. Please take a second to like and subscribe so you stay updated on every new change affecting Social Security. And I'd love to hear from you. If you have a question about this topic, or really any Social Security issue, leave it in the comments below. I will personally reply.